getting the right team on site is so critical. If your residents are all concentrated in one industry, you're at a much higher risk.
How did you first get into real estate? Was there a moment or experience that made you realize that this is the path you wanted to pursue?
Real estate was a powerful way to create tax efficient income and build wealth. I don't see a better place to put my money right now.
Were they very much engaged in your training, or was it more of this is the task, this is what we're looking to do, and you figure it out?
I remember I walked down to the 7-Eleven, grabbed a white Monster, and then I hopped on the train and went to the library, typed up a clean cover letter. I basically offered to work as an unpaid intern.
Welcome to another episode of the Dealmakers Chronicles. Today we're joined by Nick Belbas, Director of Acquisitions at Granite Towers Equity Group. Welcome to the show, Nick.
Thanks for having me, guys.
It's a pleasure to have you on. So one of the first questions we'd like to ask everybody who comes on the show is, how did you first get into real estate? Was there a moment or experience that made you realize that this is the path you wanted to pursue?
Yeah, one moment comes to mind. I was a senior in college studying finance at the University of Utah, and I was in my real estate finance class, was really digging into the textbook, and I learned that the taxable income from a real estate property does not always equal the cash flow that the property generates. They're two completely different things. And when I learned that, I just realized that real estate was a powerful way to create tax efficient income and build wealth. So that class was a catalyst for me to get into real estate. I spent a lot of time really digging into that textbook, and I ended up acing the final exam in that class with 100%, which I was really proud of because no one else in the class aced that final exam. Around that same time, as I was in that class, fall of my senior year of college, I heard Dan Breezy, who's the managing partner at Granite Towers Equity Group, on a podcast. He was on the Bombhole podcast, which is a snowboard podcast. Dan is a former professional snowboarder, and I'm actually also a snowboarder myself. So I hear Dan on this podcast talking about real estate investing, building wealth, passive income. And I just thought, man, I need to link up with this guy ASAP. So what I did was I was sitting in my apartment watching the podcast. I remember I walked down to the 7-Eleven, grabbed a white Monster, and then I hopped on the train and went to the library, typed up a clean cover letter, dialed in my resume, and I basically offered to work as an unpaid intern. As I was listening to some of the episodes of Dealmakers Chronicles, it seems like that's a common theme among a lot of people in real estate. They start out as in that unpaid position. So I grinded it out for 8 months through my senior year of college, underwriting deals and doing whatever else came across my desk. And then right when I graduated college, started full time at Granite Towers Equity Group and been locked in ever since.
Well, it's a very interesting story. It's one of, like you said, a lot of stories kind of start that way, right? You find somebody or a company that you really gravitate towards and you're willing to work for free, right? You like, as long as you get me in, it's like, listen, I'll park cars outside, whatever you need, I'll bring coffee. I just need to be in the building. Let me show you what I can do, and then move on from there. So once you're in Granite Towers, right, and you work in those 8 months, you said you're still in college during this time, right?
That's right.
And once you graduated, you became full time. And then tell us more about, now that you're full time, some of the things that you were focusing on to now you're being kind of overseeing everything from initial finding the properties to closing.
Yeah, absolutely. So as when I started full time as an analyst, I was mainly underwriting new investment opportunities as well as creating all of the marketing materials to present these investment opportunities to our partners. And really, one area where I brought value early on is overseeing the information systems at Granite Towers. We had a growing portfolio, and when you're asset managing 1,000, 2,000, 3,000 units, you have to hone in on your data, your lease trade outs, just everything needs to be in an organized format across the whole portfolio. So I was able to really dial that in, and I moved into communicating with investors, overseeing investor relations, and then I really got some exposure to all different areas of the business, which was definitely a great learning experience early on.
So let me go back to the snowboarding podcast. So is the snowboarding podcast, do they bring on entrepreneurs, or is this strictly people who snowboard and that's the conversation they're having?
So the Bomb Hole podcast it's all about professional snowboarders. They bring on professional snowboarders to talk about whatever's going on in their life. It's a good one.
Okay, so the fact that this, the principal of the company happened to be in real estate, that was just a lucky event, right? So I
Yeah.
assume he's that good that he's on this podcast. Is he a professional?
Yeah, Dan actually he's won multiple X Games gold medals,
Oh
and
wow.
he had a 15-year career as a professional snowboarder, and then you can't do that your whole life, jumping off of roofs and doing this crazy stuff, risking your life. So he had to figure out a way to transition into another career, and it ended up being real estate.
It's so interesting, and that's why I always ask this question. Everybody's path to real estate is just so interesting. But the way you just came from a podcast completely unrelated to real estate, and now here you are. So when you called Dan and you said, I watched the podcast, I've read the book, I want to save taxes, I never want to pay them in my life, I want to work for you. What was his reaction? What's the first thing he said? Was it, oh, was he startled, like, oh, okay, yeah, sure, why not? Or was he like, yeah, absolutely, I see your ambition, let's bring you on, let's bring you on. What was his reaction like?
It started out, um, I had an interview. He wasn't immediately sold on me. Dan and Mike interviewed me, and I think they saw some potential. They saw that I knew my stuff pretty well when it came to finance. I was a good student, and they decided to give me a shot. They didn't really have too much to lose, so they just taught me how to underwrite deals, and I started doing that for them. And it turned out to be a good fit, just with core values. And from there, they just decided to keep me on the team.
Were they very much engaged in your training, or was it more of this is the task, this is what we're looking to do, and you figure it out?
It was I think they were pretty involved in my training at first, but at the same time, I'm a problem solver. I'm not gonna shoot them a text every time I run into an obstacle or when I don't know something. So I was able to hone in on that skill set on my own while also having them to bounce ideas off of and guide me along the way. So I definitely continue to learn a lot from Dan and Mike to this day.
And what asset classes are you focusing on now?
So Granite Towers is focused on multifamily and triple net lease assets.
Was there any
Okay.
big lessons from your time in the first few months that learning the business that kind of shaped how you approach the deals today?
Absolutely, man. I mean, this is back in 2021, and one of the biggest lessons I would say is just understanding the financial health of your residents and their sensitivity to shifts in the economy. Back in the COVID era, you had huge amounts of government stimulus entering the pockets of all of the renters, and the effect was you saw rents skyrocketing and everyone was paying their rent. Now, when that stimulus cut off in some of these markets, you saw increased delinquency because people didn't have people couldn't afford those rents anymore. And
Mhm.
a deal that might have been collecting 95% of the income the year before, all of a sudden you're seeing 10, 15, 20% delinquency, hundreds of evictions, and there was some pain in the market. So the lesson there was just to understand the residents at the properties you're buying, understand their incomes, and make sure you're buying properties with diverse job markets nearby. If your residents are all concentrated in one industry, be it agriculture, oil, stuff like that, you're at a much higher risk of losing jobs in that industry and losing residents because of that. So, getting to know your residents was a big one. Another lesson I would say is just leadership in property management. Getting the right team on site is so critical. You need A players that align with your core values. At Granite Towers, we're looking for our on-site staff to be relentless, people who are open to constant and never-ending improvement, people who are always do the right thing, and people who have a positive mindset. Because if your on-site manager and your leasing staff are don't believe that they can lease, you could have the best asset in the world and it's still not going to perform. So you need to identify your on-site team with the right core values, and then you need to lead them. You need to connect with them, make sure they have the training and the resources they need to be successful, and continue to lead them every day to continue to drive performance at that asset. Those
Uh,
would be a
do,
couple big lessons.
do you hire third-party managers, or do you have an internal management team that oversees all your assets?
We hire third-party management, but I'd say we are pretty intimately involved in leading the team still.
And in terms of footprint, are you guys just local to Utah, or you guys invest out of state as well?
So the markets we are active in are Dallas, Fort Worth, Nashville, and Minneapolis for multifamily. With triple net lease assets, we're looking for properties nationwide. We're not as specific on the geography.
Understood. So no assets in Utah.
That's right.
Is there a specific reason for that? That you guys being from there and not having invested in the state?
We're actually spread out. The majority of our team is in Dallas, Fort Worth.
Okay.
In terms of your strategy, do you just buy the property, optimize the management aspect of it, increase the rents a little bit, or do you do a more heavier value add where there's construction involved? Like take us through your strategy on how you optimize the asset to hit the best returns.
Absolutely. Every asset's a little bit different. What we're really looking for is assets with the opportunity to add value in really strong submarkets. So we want to see the surrounding properties in the neighborhood at 95% or more occupancy, just showing really strong demand for apartments. And then we want to, in a perfect world, we would find an asset that hasn't been upgraded yet. And the surrounding properties, maybe there's a couple surrounding properties where they've done the upgrades to the quartz countertops, the stainless appliances, new fixtures, new floors, and you're seeing those material $100, $200, $300 rent bumps from those upgrades. So, and in terms of our business plan, it varies depending on what the asset needs. However, our asset management team has a lot of experience in construction, so we're open to doing major improvements. We almost always do paint, fix up the carpentry. If roofs are needed, of course, we're going to put the new roof on it. And then we we decide about interior upgrades just depending on what the submarket has proven out, because these days it doesn't always make sense right now to spend that $12,000-$15,000 per unit, because of just the market right now has, especially in Dallas and Nashville, you've seen a significant amount of supply hitting the market, which I'm sure we'll get into a little bit more. But, back 5-10 years ago, you would always see those successful $200-$300 rent bumps when you put in the stainless appliances and the hardtop counters. Now it's not it's not always there. It's not always a certain play to just get those rent bumps from doing those simple upgrades. So you have to be really strategic with just understanding the submarket, understanding your comps, and understanding what these residents are looking for in terms of unit upgrades, amenities. So I hope that answers the question.
No, no, it absolutely does. It's just there's a lot of things involved, and I would think with multifamily, the business plan is a little more straightforward than buying a triple net property, right? Net lease property. So with those, is it more of a coupon acquisition type play? Because I would think it's challenging to take a triple net property and give it a significant value add because you're confined to that lease. So is that more for cash flow and just tax write-offs, or is there a value add strategy in that play?
Yeah, that's exactly right. With the triple net lease, we're not doing any value add. Currently, what we're actually focused on is single tenant retail properties, specifically car washes. So we have bought 2 Mr. Car Wash properties so far. And what we love about these car washes is we work with major tenants like Mr. Car Wash or other big operators with a significant amount of stores. And these leases are backed at the corporate level. So even if this one location isn't doing too hot, the corporation of Mr. Car Wash, who Mr. Car Wash is the biggest car wash operator in the nation. They have over 500 locations across the United States. They're they're a publicly owned company. Their corporation is backing this lease. So even if that location that we own isn't doing too hot, they're still going to pay the rent. So our strategy is we buy the car wash with an absolute triple net lease in place, meaning the tenant pays repairs and maintenance, insurance, and property taxes, removing all expense risk for the landlord. We buy with a corporate backed lease with at least 15 years of lease term remaining. And another great thing about these car washes in 2025 is they offer significant depreciation losses. So with car washes, you can actually write off 100% of the improvements as a depreciation expense in year one of ownership. With the financing that we're working with, we're typically getting 50% loan to value on these properties, which allows us to provide our investors with 130% plus depreciation losses in year one of ownership. So, around this time, Q4, everyone's looking, or, a lot of investors are looking for those real estate investments to get those depreciation losses. And this asset class just offers stable cash flow with these long-term leases with either annual rent increases, or it might happen every 5 years. You're protected against inflation, you're collecting steady cash flow, and it's a really stable investment in a resilient asset class that has proven to do well during economic recessions. So that's why we're really excited about car washes right now.
So you mentioned the financing aspect, that's 50% loan to value. Who are your usual financing partners? Are those banks? And like what rates do you see for purchases specifically like car washes?
Yeah, the financing landscape is interesting. It's, you have to vet out your lenders a little bit more and shop around a little bit more. But at the end of the day, we have been going with banks so far or credit unions, and you're typically seeing a spread of 250 to 300 basis points from the treasury.
Understood.
So
Yeah.
I would, given that you guys are pretty much doing the using pass-through vehicles where an investor can take on that tax loss, I assume that you're syndicating most of your deals. It's not so much from a fund structure financing; it's more like just individual per deal syndications, right?
That's right. So far with our multifamily deals, we've done all deal by deal syndications. With our triple net lease deals, we actually just launched the Granite Triple Net Lease Fund 1, which is a 506c offering, and we'll be purchasing about 10 car washes over the next 2 years with that fund. So we're really excited about that.
Very nice. So I was looking over your website, and one thing that stood out to me is that it seems like you guys take a conservative underwriting approach to your deals. Conservative is great, but in a market that's competitive, and I can't say that there's an abundance of deals. General partners are battling each other, trying to outbid each other, trying to get deals. So, so how are you guys managing being conservative in your underwriting and still winning deals and beating out other general GPs that are involved?
It is getting more and more competitive with the market starting to pick up again. What we do is we stick to our guns and we find assets where we know we can move the needle. The way that we think we have an edge right now is just taking into consideration the best data. We're not just looking at, the 1 mile median household income anymore to understand our propensity to increase rents at an asset. With AI now offering more and more data available, we can get in deeper at the asset level and understand how much money these tenants are making, where their jobs are located, what industries they're working in, the surrounding home prices relative to rent, population growth in the area, their credit card balances, their apartment shopping behaviors, as well as other spending behaviors. And by looking at all of this data, we can understand with much more accuracy our propensity to increase rent at an asset, our vacancy down the road, and we also use this data to inform our CapEx decisions. So really, we're sharpening our underwriting with access to the latest data that's now becoming available. Another thing that we stay true to is, it's a kind of an industry standard almost to use that $350 a unit for replacement reserves, when in reality, if you're buying assets built in the 1980s, you're gonna see a lot more than that. So we always budget for significant future unit turns, and we just make sure our CapEx budget is healthy and ready to take the asset up to the next level where we need it and maintain it throughout our ownership. Like you said, competition is picking up. The markets are picking up with transaction volume in Dallas and Nashville. So we're not going to win every single deal, but we just need to maintain our conservative underwriting and find the assets where we can move the needle, and those are the ones we're going after.
You're also a limited partner in your some of the multifamily properties totaling over 700 units. How has being an LP influenced your approach to acquisitions and communicate with investors as a GP?
Yeah, well, I'm definitely one of our smallest limited partners, by the way, but I would say
For the time being,
for the
right?
time being, that's right. Anyways, I just think that these properties, for me personally, this is where I want my money right now, because we have direct control over these assets, and I've just seen the way that we can create value by coming into an asset, bringing it to the next level, continuing to build community, building that community ties, and not only building community, but bringing the, driving income and creating that NOI boost, which directly increases the value of the asset. I just I don't see a better place to put my money right now with where I mean, I do invest in the stock market, and I haven't been around for long enough to really to to really be saying this, but I'm just a little bit concerned about how it's just been running off lately. And the stock market's really high. I don't really want to put my money there. And with with real estate having seen some pain over the last few years, we're talking to a lot of major investors who are extremely tuned in and have been through multiple economic cycles. And a lot of these major players are deploying capital and are coming back into the market. So just with all these things at play, and with my understanding of how we're creating value at these assets, I don't see a better place to be putting my money right now.
What when you come in as an LP, what returns are you happy with? Or maybe I should even ask, like, what returns do you offer your LPs? What's a good metric?
A good metric, we're typically on a multifamily deal, we're typically looking at a 5-year hold period, average cash on cash return of 6%, and an equity multiple of anywhere from 1.8 to 2x over that 5 years. So that's pretty standard with the properties we're looking at these days.
Yeah, I mean that's a extremely good return because if you're getting a 6% cash on cash and it seems like an 18% IRR, relatively safe asset if it's cash flowing, and the return is still substantial. So you guys are finding those the needle in the haystacks, I assume. And you're operating in Dallas, Nashville, Minneapolis, like you mentioned. What's your current read on the markets? How are you navigating the shift in cap rates, rents, investor sentiment?
Yeah. Dallas and Nashville are, from my perspective, two of the best places to be investing in real estate right now, simply because of the landlord-friendly laws, the business-friendly climate. There's no state income tax in these states, which draws businesses and employees, just driving demand for apartment. Both of these markets have seen significant job growth over the last 10 years, which continues to fuel those economies today. And in Dallas, well, in both markets, supply has been the main challenge over the past 5 years. We've seen a significant amount of supply hitting the markets, which has put a damper on rents and increased vacancy. So within Dallas, what the data is saying right now is that we're going to see vacancy start to come on down, and over the next 12 to 24 months, should see everything stabilize and rent growth start to pick up again. That's just what the latest data is saying. Uh, Currently in Dallas, there's 29,000 units under construction, which is the lowest amount in the construction pipeline since 2016. So as you see this construction pipeline exhaust, less supply coming online, and the economy continuing to grow, I think that there's a really solid narrative for continued growth in the Dallas rental market. Nashville, um, Nashville is a smaller market. We see less deal flow from Nashville simply because there's not nearly as many residents. However, this is a market that's seen significant population growth over the last 10 years, significantly outpacing the United States and other metro areas. And it's a safe bet that that's going to continue with the amount of investment from big companies like Oracle and Amazon moving to Nashville and creating jobs. So supply, again, has been a challenge with tons of deliveries over the last few years in Nashville. However, we see this as a strong market moving forward. And we're continuing in both Nashville and Dallas to seek out submarkets that are insulated from oversupply risks. And like I've been saying this whole time, just finding those assets in strong neighborhoods where people want to live and finding those assets where we can create value. Looking at Minneapolis, it's a slightly different story. With Minneapolis, there's still solid population growth, steady job market with a lot of high paying advanced jobs. And in Minneapolis, compared to Dallas, you don't see the same kind of competition for deals. So I actually grew up in Minneapolis. Well, I grew up in Edina, which is a well-known suburb of Minneapolis. We might have some haters in the comments about Edina. We'll see. But anyways, we're excited about Minneapolis in select markets. For example, we bought a couple properties this summer. One of them's in Chaska, one of them's in Minnetonka. These are strong markets. These are residents with solid incomes. They can afford to pay the rents that we're looking to charge. There's not an oversupply risk in the area like you're seeing in some of these Sunbelt markets. And with the lower competition for these deals, you're seeing higher cap rates in these markets than we could achieve in Dallas or Nashville. So I just think that's what's attractive about Minneapolis is it's a steady growing economy with population growth, and it's not on the radar of a lot of big institutional players.
What's the eviction process look like in Minneapolis? I'm very familiar with Nashville and Dallas. How long does it take to evict someone who's not paying rent?
In Minneapolis, it can be a little bit more drawn out. I don't know the specific timeline, but that's where it comes back to finding assets where it's not going to be a problem. These two
Mhm.
assets that we bought this year, for the past 4 years, these assets have been at 95% occupancy. So Dan, Mike, and myself are all from Minneapolis. Mike Roeder still lives in Minneapolis. This is our backyard, and we're focused on finding the best assets in strong markets where you're not going to see delinquency as a major concern. The residents of these assets care about their credit and they care about their financial health. So that's I think the eviction process can be a little bit more drawn out, but you just got
Mhm.
to avoid those kind of assets.
Yeah,
So
yeah, that makes a lot of sense. We briefly touched on depreciation losses in real estate. So, for an individual who wants to invest $500,000 and he likes everything he hears, 6% cash on cash, 18% IRR, sounds magical. But how do I save on taxes? If I want to invest, call it $500,000, how would you best advise them on what the depreciation losses will look like for them?
Yeah, so I'm not a CPA, so I'm not going to go too deep in the weeds on
Yeah,
this
just
one.
a high
But
level, like how can
yeah,
I save taxes on real
oh,
estate?
oh, absolutely. So earlier this year, there was some legislation passed that brought back 100% bonus depreciation in real estate. What that means is when you buy a property, a real estate property, you can write off a significant percentage of that property as a depreciation expense in the first year of ownership. For example, we bought that property in Chaska, Minnesota earlier this year. I think the depreciation losses were 70 or 80% of your investment amount. So for an investor coming in with $500,000, like you said, that would be roughly a $400,000 depreciation loss in year one. Now, it's important to note that you're not, it's, it's deferring your tax bill because there is a depreciation recapture on the back
Mhm.
end when we sell the property. However, for an investor to come in and save on taxes, it's important to talk with your CPA and understand what kind of income you're making. These losses, in most cases, can offset your passive income. So the IRS has three separate categories of income they typically recognize. You have your passive income, which is your income coming from businesses that you don't materially participate in, like a real estate investment. For example, you have your portfolio income, which is income from your stocks, bonds, interest income, stuff like that. And then you have your active income, your earned income from your W-2. For most people, the only income that you can offset with these depreciation losses is your passive income. There are certain situations where you can use these losses to offset different kinds of income. And again, I really encourage anyone to reach out to your CPA and have a conversation. Ask if you think, if they think you can benefit from depreciation losses from a real estate investment, and make sure that your CPA is someone who's knowledgeable about real estate. If you need a referral, I'd be happy to provide one. You can reach out to us and we can get you linked up with a solid CPA.
Mhm. So me and my brother, we also invest a lot. And after the property goes full cycle, me and my brother always have a debate, right? What do we do? Do we just take the money and deal with the depreciation recapture, or do a 1031? My brother, and this way you don't have to do that, right? My brother is always against the 1031. He's like, okay, if you do a 1031, there's a good likelihood that you're working within a certain time frame. There's a high probability that you'll get into an asset that you don't want to be in, just not to pay all those taxes that you depreciated, and plus your capital gains tax from the amount of property that appreciated. What is your view on 1031? Does it make sense to just keep rolling it from one property to the next until you're 70 years old and just cash flow in a really large one? Or do you think it makes more sense to not do a 1031, pay those taxes, but be more selective about what opportunity you go into and make sure it's optimal and you're not just buying any property just to save on taxes?
I think every situation is unique. Some people have 1031 funds from a property they've already been holding for 20 or 30 years. And in that case, I think it would make more sense to continue on that path. But like you said, it has to be the right deal. I mean, you don't want to risk losing it all in a subpar deal. So I I guess just understand the investment, get to know and like the general partner if you're going to become a limited partner in this asset, and talk to your team, talk to your legal team, your CPA, and plan out the financial future that you want to create for yourself. I That's what I would
Yeah.
say.
Earlier, you mentioned AI being part of your acquisition process now. Can you tell us some of the ways you're integrating AI, some of the tools you're using? And because we're hearing it more and more across the industry that AI is becoming an intricate part of the process, what you're screening properties, when you're managing properties, and when you're planning to exit as well.
Yes, AI has been a focus at Granite Towers for the last couple years. We know that it's going to change the industry. Things are going to change fast, and we want to be at the forefront. So, like I was talking about earlier, AI has created access to more and more data, like I was speaking about with incomes, spending behaviors, apartment shopping behaviors, stuff like that, that we can use to inform our investment decisions and sharpen our underwriting to create more realistic underwriting and really find the best assets. Other areas where we see AI as being useful is one of them is understanding our resident sentiment. So, AI can not only analyze Google reviews, but look at localized social media trends to see what residents are saying about the properties they live in. And this can just allow you to create more community and create a strong community where people want to live. Another way we're using AI is obviously underwriting deals. It's speeding up the first pass process of getting all the data in the spreadsheet and allowing our team to focus more time on the critical tasks related to underwriting. So we are testing out a few different underwriting softwares right now, and it's with me being someone who's underwritten several hundred deals, it's really incredible what this software is doing. And I think it's just critical to stay on the forefront of it. AI is such a powerful technology to utilize as a thought partner as you are going about your life in both your personal life, your business, and it's allowing our team to lead more effectively, make better informed decisions in every area of the business, and ultimately move more efficiently and make the best decisions possible. So
Yeah.
that's what I think about AI.
So, you mentioned on staying on the forefront of AI, and even though it sounds decently simple, right, I found that pretty difficult to do. Especially, speaking to other GPs and even us on our company, and there are always new tools, and it almost seems like you need to delegate a few hours in every week just to see if there are any new tools that came out that you can utilize. Do you guys have a process for seeing, oh, is there a new system or new tool that came out that may help us with any one of our processes? Or is it more of a, if I hear of it, I'll implement it?
Yeah, we're constantly having conversations with people in the industry, understanding the latest tools and speaking to other groups as well as our LPs who are staying at the forefront of this stuff. So that's been our strategy, is constantly talking to industry experts to see where we can implement these technologies.
When you're evaluating a new opportunity, I want you to take us to what you first do. You have a broker or someone send you a deal, says, "Hey, take a look at it, see if it's a good fit." What's running through your mind in those early stages? What are some of the first things you look at to see if this deal is worth pursuing?
Right off the bat, I'm looking at the delinquency as a percent of gross potential rent. Are these residents paying their rent?
Mhm.
Are evictions a problem? Next, we're looking at the location. We want to see, obviously, great location with a strong submarket. We're looking at the comps and seeing where their occupancy is at and where their rents are at. And then, of course, those are the big things right off the bat: delinquency, occupancy in the submarket, and income levels. Like I've been saying this whole time, understanding those three things can allow us to kill a deal pretty quick.
How many deals would you say that you see per week?
20 to 30.
20, 30 deals. And out of those 20 to 30 deals, how many would you say you, after your high level overview, you actually sit down and start, sharpening the pencil on?
2 or 3, sometimes just 1.
Two or three, sometimes one. Do you see more deals coming your way in the coming months and in the upcoming year with the rates having to come down and financing being cheaper now versus before?
Absolutely. We're seeing transaction volume pick up and more deals hitting the market. I think that things are going to become competitive again, and it's going to become more and more important to move fast and get your initial diligence completed and get those offers through, as well as just having strong relationships with all the brokers in our target markets. I think that things are going to heat up again.
Do you see yourself pursuing more multifamily deals in the next 24 months, or do you see yourself pursuing more triple net lease deals? Or is it just whatever deal makes more sense, that's what we'll go after?
We will be pursuing both. I think our target is 4 or 5 multifamily deals in 2026 and another 8 triple net lease deals.
The acquisition role can come with a lot of pressure, right? Because markets move fast, and you're putting other people's money on the line anytime you make a purchase, and meeting the investors' expectations with the kind of returns that you're known for. How do you personally stay grounded? I would assume snowboarding is a big part of it.
Yeah, I mean, in the wintertime, when I can get up to the mountain It's always a good time. Personally, I would say just taking time for reflection, daily exercise is really critical for me, and eating right, but staying grounded is a constant effort for me, and just got to keep at it every day. In terms of making decisions, I always rely on my team. I mean, if we are making an offer on a deal, we've already gotten our property tax guidance, insurance quotes back, reviewed the budget with our property management partner. Our asset management team has walked the deal. We've honed in on our CapEx budget, and our whole team has reviewed the underwriting. So I'm not in this alone. It's a team effort to get these deals done, and I always rely on my team for all the decisions.
How big is your team now at Granite? Like taking everybody into account, acquisitions, principals, asset managers, all the above.
Let me think. I think we're at 13 people now.
Okay.
Yeah,
It seems like that's a great size to where you stay lean and efficient and still very mobile.
absolutely. We've made a few key hires this year. Jason Myers, our chief operating officer, has been a great addition to the team, just leading our asset management division and driving excellence across the portfolio. We've also recently onboarded another asset manager and a regional maintenance director, as well as a collection specialist. These are all key hires. So we're excited about the foundation that we're building as we go to continue growth.
I love it. When it comes to snowboarding, is it true that the taller you are, the more challenging it is for you to snowboard? Or is it a myth?
It's a myth. It's a myth.
Mhm.
One of my good friends is 6'7", Rob Rothler, and he's a pro snowboarder. He's one of the best in the game. I think that there's, like, if you want to be a slope style competitive snowboarder, it's better to be one of the smaller guys like Marcus Cleveland, who can do the quadruple corks, and you're really tight like in a ball, and you can just,
Mhm.
stomp it. You're light, you can make it happen. But being a little bit taller, I don't think it's I don't it's not harder to snowboard. It just limits
Yeah.
your opportunities in the competitive world, I would say.
I think I'm gonna probably cut out everything you just said because over the last 15 years, I've been telling people that the reason I suck is because I'm taller. And I like my version better. I don't like your version, so I'll stick to mine. No,
Yeah,
I'm
Either
he's
way,
only
joking.
man.
six
I'm
foot
Yeah.
three, so he's not even. Yeah,
Whatever makes you
you
sleep at night, that's the most important thing in life, right? Even if it's not the truth.
Hey man, we'll
So
get you some lessons, man. Come out to Salt Lake City. We'll hit Park City. It'll be a good time.
I think I will take you up on that. I think I should hit those mountains, at least try. Maybe bunny slopes will work for me. So it seems like you have a passion for real estate. It started with a textbook and then it transitioned into a real job to where it seems like I see that you have a lot of passion for it. Take me through the next 5 to 10 years. How do you see yourself evolving in this space?
You know, personally, my plan is just keep my eye on the ball, remain humble, and continue to grow within this great organization. Like I was just saying, we have built the foundation over the last few years to create something that's truly incredible. And with the leadership team that we have in place, as well as the the opportunity right now with where the market is at, I see tremendous opportunity for myself within this organization, and I can't wait to see how the next few years unfold.
I love
absolutely.
it. I love it. Well, I look forward to seeing it as well. Nick, thank you so much for coming on the show. It was nothing but a pleasure speaking with you, learning about your market, learning about you. I look forward to staying in touch with you. We're going to monitor how you guys are doing and where you get going. And I'm sure we'll have a whole bunch of conversations offline as well. But thank you so much for coming on. I really appreciate it.
Thank you guys. It was a pleasure to be on, and let's stay in touch.
Absolutely. Thank you.